Welcome back, everybody, to Untangling Climate Finance. I'm Jay Tipton from Gordian Strategies, and happy New Year. I'm really excited to welcome you all to the first episode of our fourth season here in 2026. We've got a great lineup this year, and we're kicking things off with a topic that sits at the center of daily life: agriculture. Today, I'm joined by Maggie Monast, the Senior Director of Climate Smart Agriculture at the Environmental Defense Fund, or EDF. Maggie works at the intersection of agriculture, finance, and policy, helping to ensure that the systems that fund farming are also supporting resilience and real climate solutions. And here is why that matters. The entire human population depends on agriculture, and ag is currently sitting on the front lines of climate change and environmental challenges. Farmers depend on predictable weather and healthy natural resources, and climate impacts are already hitting yields, with major grain crops projected to face significant declines by mid-century. At the same time, ag and land use account for about a third of global greenhouse gas emissions, including methane and nitrous oxide. But despite its important role, the agri-food sector receives only a small share of global climate finance. Maggie points out something that should stop all of us in our tracks. Global agriculture credit is roughly 1.2 trillion USD, which is roughly the size of the entire US mortgage market if you divided it by 10, and absolutely tiny next to global bond markets, which sit at about 128 trillion US dollars. If even a fraction of that 1.2 trillion USD is aligned with climate smart practices, it could dwarf current climate finance flowing into the food systems while helping close the gap between ambition and implementation. So in this conversation, we dig into how ag lenders are starting to respond to climate risk, what farmers actually need to make changes that pencil out, and why blended finance can be such a high leverage tool in the real economy. All right, it's Maggie time. Hi, Maggie. Welcome to the show. Happy 2026.
Hi, Jay. Happy New Year.
Thank you. How many times this year have you accidentally used 2025 so far?
I'm doing pretty well this year.
Practice. I'm doing well as well. One of my friends was like, I've already done it 6 times. And I'm like, I feel like I'm getting better with age. So I don't know what that means.
What is time anyway?
Anyways, where are you calling in from?
From North Carolina. I live just outside of Durham, so I'm in the woods.
Sounds nice. How's the weather?
It's cold, actually.
Yeah. Well, hopefully some sun in the future. Okay. So Environmental Defense Fund, to get us started, why don't you share your name, your title, and what you focus on specifically at EDF?
I'm Maggie Monast. I am a senior director at Environmental Defense Fund on our agriculture team, and I lead our agriculture finance and insurance work globally.
Beautiful. And if you don't mind, I would love to hear your background, how you got to where you are today.
I've always been interested in the intersection between agriculture, environment, and economics. And so my whole career has tracked that path, whether it's been working directly with farmers and their advisors, trying to find economic optimums for fertilizer rates, or working with major companies in the agricultural value chain who are setting sustainability goals and figuring out how to implement them with farmers, to now working directly on agriculture finance and insurance, figuring out how to embed the value of resilient agriculture into those financial and insurance systems around the world.
Excellent. And did you grow up in an agricultural family, or did you just find your way to it because you thought it was interesting?
I didn't. I grew up in a pretty small town in a rural area, but I think I just realized that the food choices that we make every day have a huge impact on the world.
Yeah.
And that has always fascinated me. I mean, I love food. I love to cook and eat. And then it's really interesting how the food that our farmers grow have such an impact on the global economy, food security, environment, etc. So I just find that endlessly interesting.
Yeah, you and I could probably have a separate podcast conversation only about that because I'm the same as you. I think sometimes you and I probably sit in like this vacuum where we think that everybody knows like the impact of their food or where their food comes or how much is wasted. And in reality, that's not true at all. I think a lot of people aren't aware of that. So, anyways, for another time.
And it's really amazing to talk to any farmer and they are thinking about the day-to-day weather on their farm and soil conditions. And they're also thinking about trade with Japan and global markets. And
Yeah.
it's just incredible the amount of knowledge that any given farmer has about so many different topics.
Absolutely. Well, this is our climate finance entry point. Obviously, this podcast is Untangling Climate Finance. And I think when people hear the term climate finance, they often are thinking markets or investors, and probably not often thinking farmers and lenders. But as you know, that's such a critical point of all of this and probably often overlooked. So, why do you think that ag, farmers, and the lenders in that space are such a critical part to the climate finance ecosystem?
Well, starting with the intersection of agriculture and climate, just to put some numbers on it, obviously climate change has a massive impact on agriculture. Agriculture is really on the front lines because farmers depend on predictable weather conditions and natural resources in order to grow the food that you and I eat every day. Climate change has already reduced yields of major crops around the world. And as we look into the future, those major grain crops are projected to decline in their yields by 20% or more by 2050. And so climate has a major impact on our ability to produce the food that we all need. At the same time, agriculture and associated land use change account for about a third of global greenhouse gas emissions, including some of the highly potent greenhouse gases like methane. Ag produces about half of that, and nitrous oxide about two-thirds. And so, if we fixed electricity systems around the world, if we fixed transportation, our food and agriculture systems would still add 1 degree C to warming by the end of this century. So, really, agriculture is unavoidable when we're thinking about both resilience to climate change and mitigating greenhouse gas emissions. Now, if we turn to the money, despite all of those numbers that I just said, the agri-food sector receives just about 7% of all climate finance globally.
Wow.
And so, when you think about that, it's just not reflective of the magnitude of the impact that agriculture can have. And the reason that I then think about the existing agricultural finance system is that agricultural credit worldwide is about $1.2 trillion. So, if just 10% of that were aligned with climate friendly farming practices, that would easily surpass the current 95 billion in global climate finance for agri-food systems from all public and private sources.
It's massive, but it could be more. It's funny. I was just having a conversation yesterday with a friend here in Spain. We were having a cup of coffee, and he had noticed that the price of coffee has gone up.
Mhm.
And that's climate, buddy.
Yeah.
I was like, obviously, it's not the only reason, but the food, the value chain of coffee beans, of course, is being impacted. But, anyways, you really have to like consider on that scale, as you said. So, obviously, ag is on the front lines of climate change, but from a lender's perspective, how is climate risk showing up today in ag loan portfolios?
So, ag lenders provide loans to farmers for all sorts of things for farmland, of course, for equipment, and also for things like annual operating expenses and other on farm infrastructure changes. And what's interesting is that in many areas around the world, including the United States, it's kind of a separate financial sector from the broader commercial banking sector that you would think about. So in the US, about half of ag lending is done by the Farm Credit System, which is a system of financial cooperatives. And so those ag lenders, they tend to be concentrated in agriculture And then they also tend to be concentrated in specific regions. So if you think about how, climate change has regional impacts, and then also agriculture is particularly at risk, you can see how agricultural loan portfolios really can have high levels of climate risk in them.
And you had just said, like, it's pretty impressive from your perspective that the farmers understand like weather and seasonality differences. How are ag finance institutions beginning to translate that volatility and risk from that into decisions that they make and then maybe loan structures as well?
Well, we just asked them. In 2025, we did a global survey of over 150 agricultural finance institutions across 17 countries. And we asked them both about climate risk, their perceptions of that, and also about opportunities in supporting more sustainable forms of farming. And so we found that 95% of our respondees found that climate change is a material risk to their business. Now, that's up 7 points from the first time we did the survey in 2022. So that awareness is rising. And then also, nearly 90% of ag lenders expect their customers, farmers and agribusinesses, to be negatively affected by climate change, particularly through higher production costs and insurance premiums.
Is that survey publicly available?
Yeah, absolutely. You can find it on our website.
Beautiful. Then in that case, I will make sure that I link it in the show notes and send it out once this podcast goes live. So, what motivated the survey? And then was the focus only with lenders, or did you survey other value chain stakeholders as well?
The focus was on lenders because that really has been an overlooked area. And to our knowledge, this is the only survey of agricultural finance institutions. And as I mentioned, we did it for the first time in 2022, and then we just did a refreshed version in 2025 so we can start to see trends. And ag debt really is the money that fuels farms on a day to day basis. And so that was the focus. We did ask ag lenders about broader market trends to understand their perspectives on those as well. So we're beginning to see what motivates them to move from awareness to action on climate and sustainability trends.
And what was that? Were there any other key takeaways that was part of the motivation?
The big motivation for ag lenders to engage on these topics really goes to their fundamental business case. It's the needs of their farmer customers, and it's also broader market trends. So we've seen a lot of advances in food and agriculture companies setting climate and other sustainability targets and building out programs that are intended to engage farmers and support them and adopting new climate friendly practices. And so those two sources of demand, both from the farmers themselves and from the broader food and agriculture market, are the main motivators for ag lenders to engage on this topic, in addition to understanding the climate risks facing their portfolios.
hmm And as you had said, like the risk perception is increasing. So clearly the message is being heard, which on one hand, it's unfortunate that we're in that situation, but at least on the other hand, there's action now versus just awareness.
Yes.
So to piggyback off what you said about some programs, are you able to provide either examples of like sustainable finance products or specific programs if you have any in mind that have been developed by lenders?
Yes, we're getting there in terms of lenders figuring out how to align their financing with what farmers need to adopt more sustainable practices and technologies. Because oftentimes the economics of those practices and technologies are just different from conventional agriculture. There might be a transition period where farmers are figuring out a new system. There might be some different costs that they need to take into account. And so that represents a real shift for lenders to figure out how to better serve those farmers who are trying to make those changes. Now, globally, the survey found that 85% of ag finance institutions offer sustainability related financial products or services, and even more plan to add new offerings in the next 3 years. But as we look at the US still lags. So less than half of ag finance institutions in the US offer those sustainability related financial products or services. But the good news is that 59% plan to develop them in the next 3 years. So the US is behind the rest of the globe in developing these products and services, but they're working to catch up.
Very good. For listeners, are you guys working exclusively in the United States, or do you developing these types of programs and products with countries outside of North America?
Not just in the US, we work across 4 anchor regions around the world. So the US, India, Europe, and China. And we also have a great collaboration in Canada with Farm Credit Canada.
Got it. And so, from your perspective, what do the ag lenders need to do to accelerate action?
So there are 2 things. One is they need to build ways to assess climate risk into their traditional risk assessment processes. That's one. So they understand what are the main risks facing their customers and how can they support their customers in adapting to the climate changes that they're increasingly facing. And then the other is really proactively engaging their farmer customers and their agribusiness customers, finding out what their needs are and meeting them where they are in terms of supporting their customers with financial products and services that allow them to make that transition.
And as far as the first one, which is assessing the climate risk, is that something that you're hearing from them that they're trying to do internally, or is this outsourcing? Because as I'm thinking now about the rise of AI and how there's a lot of like risk assessment groups, I don't know if that's something that can be brought in-house for a lot of these lenders, or if that's something that they're looking to collaborate with other groups on.
It's a great point that there's a lot that can be done that then ag lenders can pick up and use. So, not every single ag lender needs to do all of this from scratch, which is really important because many of these are, small banks, community financial institutions. They don't have the in-house capacity to do all this stuff.
Yeah.
Unfortunately, those tools and resources are still pretty nascent for the agricultural finance sector. And really, what needs to be done is we have to link the global climate change models and regional climate change scenarios up with crop and livestock productivity models. And then once that is done, we can connect that to agricultural risk assessment. The uncertainty often comes in that availability of the crop and livestock productivity models. And so we have built a web tool in collaboration with several major ag lenders that's an example of what's needed more broadly. And that covers a few US states and Canadian provinces and is also available on our website for folks to see what this would look like if this kind of assessment tool was available more broadly.
That's awesome. I'm sure, well, I hope that whoever you're testing this out with in terms of the lenders find it to be helpful, because that seems very powerful.
They have because we designed it alongside them. So they collaborated with us every step of the way
Perfect.
and now are figuring out how to bring that into their risk assessment process. And what I think is extra cool is that it includes some adaptation actions. So it's not just about risk, it's also about solutions that farmers can undertake to mitigate those risks. And really, this is about lenders looking into the future, figuring out what's going to be a problem for their borrowers, and figuring out how to support them in navigating this change.
Yeah, that's comprehensive. I mean, of course, like always better to design it with the end user in collaboration with you. So that makes a lot of sense. And kind of using that as a nice transition. In our correspondence before this podcast, you had said that EDF and some of your partners are developing a dairy impact fund, which is basically to help farmers overcome the financial barriers that they face in adopting technologies that might help them address climate or address risk or all of these other major hurdles that they have to worry about. And so the first part of this is, can you please describe what the Dairy Impact Fund is? And then part two is, what is the problem that the fund is designed to solve that you think traditional ag finance hasn't yet addressed?
Absolutely. So, this is an example of where we're trying to support ag lenders in financing, in this case, dairy methane reducing technologies, enabling the ag lenders to really meet farmers where they are and provide the kind of financing that they need to make this change. So, if you think about the current situation for dairy farmers, many of the technologies that help mitigate manure methane are very expensive on farm infrastructure investments. And so they have these upfront capital costs. The revenue projections are often uncertain. There are value chain companies that are trying to reduce methane and are willing to pay farmers for that. But it can be hard for a farmer to take that to their lender as evidence that they will get a return from this investment. Farmers also face a really confusing patchwork of different funding sources and programs that often have kind of conflicting requirements. And then once they get to actually looking for financing to help bridge those different sources of revenue, the financing itself can make it unaffordable for them. And so, what we're trying to do is better bridge the finance providers and the value chain companies with the farmers to allow them to have a more holistic package of funding and financing to implement these technologies on the farm. Because what farmers ultimately need is something that's economically viable and low risk, easy to access with aligned funding and financing, and delivered by their existing trusted business partners. Now, you might ask, okay, well, what's needed to make that happen? That sounds great, but how do we make that happen? And what we found is that we really need an infusion of catalytic capital to help bring all that together. And so that's what the Dairy Impact Fund would be. This is the result of a year-long process that we undertook with the Innovation Center for U.S. Dairy, where we convened ag lenders, value chain companies, farmers, dairy co-ops, et cetera, to talk about the financial barriers to adopting these kinds of practices and what it would take to move forward. And the Dairy Impact Fund emerged as the idea that most people were excited about and really mobilized around. And so it will be hosted by a third party fund manager, and it will include catalytic capital that the ag lenders can basically dip into in order to offer loans to farmers that are lower cost and more tailored to fit their needs as they're adopting these on farm technologies. So we are in the design phase right now and bringing all those partners together to make it a reality.
Well, I have a couple different comments and thoughts, but first is there any way that the listeners that might be in this space, are they able to view the current version of the Impact Fund or provide comments or get involved, or is it still going through the design behind closed doors phase?
Well, after we did all of that stakeholder work, we put out a report with 8 different financial models for the dairy sector. And that includes the Dairy Impact Fund. So that's a great place to get up to speed on what we're working in. And then I would say people are welcome to reach out to me to learn more about this, especially investors who are interested in being a part of this. This is a really interesting leverage opportunity because we have agricultural finance institutions who would be part of these blended finance structures, and we have major dairy value chain companies who would be providing incentives. And so it's an opportunity for a pretty small amount of catalytic capital to unlock a relatively massive amount of commercial capital. Roughly for every 10 or so million that we would have in catalytic capital, that would unlock about 100 million in ag debt plus incentives from those dairy value chain companies. So we're really excited about the opportunity to work with some investors who want to help us make this real.
Yeah, that's pretty substantial. Are you able to share any details on the targeted fund size?
We'd like to get it to 50 million so that it can be a standalone fund, but we also have plans for how we can make it work at smaller scales. Really, this is quite scalable in either direction. And there is just a very large universe out there of farmers who would like to make these changes, but can't do it under the current economic paradigm. So there's a lot of pent up demand for this kind of thing. And Whenever I go to dairy conferences, all I hear from farmers and others is, hurry up, like we need this, go faster. So there's a lot of interest. And now the challenge is to bring all the right partners together.
Right. And Maggie, what I like about this is that unlike in other sectors, here, the technology already exists,
Yes,
right? So it's there and it just needs to be implemented, which is a financial barrier. Versus in other major sectors, the tech is still developing and that's part of the battle. But here it's just like, listen, we know what we need to do and we know it needs to be implemented. We just bridge this gap of finance to then put it on the farms.
that's right. In our work with the stakeholders, they guided us towards a target audience of small to medium sized farms. So, 300 cows all the way up to 1,000 or 2,000 cows who typically are unable to implement large scale, like anaerobic digesters. Your audience might have heard of that technology. But there are a bunch of other manure management technologies like solid liquid separators, cap and flare systems, composting technologies that are tested, well known, scientifically validated. But just because of those financial barriers I mentioned, it's difficult for these farms to implement them. So, if we're able to create a financial package that overcomes those barriers, we would have a very wide market for potential adoption.
Yeah, and hence the impact part of the Dairy Impact Fund
That's
because
right.
it seems very right for it to be implemented and then actually have some impact right away. So that's exciting. Cool. Well, listeners, you've heard it here. If you want to get any more information, you can message Maggie and I will make sure that your contact information, if you're okay with it, Maggie, is in
Yes.
the show notes so that investors specifically, but anybody curious can reach out directly to you. All right, Maggie. So we're wrapping it up, and it's hard to believe that we're in January 2026. I feel like every time I have one of these episodes, cutting down the time, and now we're at the beginning of a fresh new year. You've obviously just laid out the Dairy Impact Fund. You did the global survey, which has been very helpful for you all in terms of figuring out your direction. So, with that said, what does 2026 have in store for you and your work specifically at EDF?
Well, the Dairy Impact Fund is going to be a major focus for us. But in addition to that, we also have several collaborations happening on the row crop side where we're looking at different financial products designed to support farmers in adopting soil health practices and practices that reduce nutrient loss from row crop production. And so we're really excited about the collaborations we're developing between ag lenders and food and agriculture companies and investors on that as well. So I think that 2026 is going to be a big year for launching new financial products and services, especially in the US, focused on sustainable agriculture. And it is really needed. The farm economy is very tough right now. Farmers are struggling. And any way that we can support them in being able to accomplish their environmental goals in a way that is economically viable for them is more important than ever. So I'm pretty revved up for 2026. I think we're going to get a lot done this year.
Yeah, you beat me to it. I was going to say it's super essential, like any other financial product that we can put out there, especially in the ag space. It couldn't be needed more than it does right now. So I'm excited to hear that you're stoked and you're going into the new year with a lot of energy because we need it. All right, Maggie. So closing out, my final question. Climate finance depends on trust, which you know, from investors, companies, public, all the stakeholders. So, in your opinion, what's one thing that the climate finance ecosystem at large needs to do better to earn and keep that trust?
For me, trust is really based on respect and building understanding. So I think the most important thing is trying to understand what farmers really need to make a change and what will be truly helpful to them. And that requires a lot of listening to farmers. And then the second thing is we try to build on existing trusted relationships. Many farmers work with their lenders over decades or more. Sometimes it's generational. They know their milk buyers or their grain buyers. And so, where climate finance can be most effective is where they are helping those existing trusted business partners of farmers do more to support their farmer customers. And so that's really where I'm most excited about the potential for climate finance to tap into this existing system and help it shift to be more supportive of farmers who are doing things that are in the long-term best interest of their own farm's economics as well as the environment.
It's ironic that the first one that you said was about listening because I think that's super important, of course. But I used to ask a question to wrap this episode up, leaning into Stoicism. And what you said made me think of a pretty classic Stoicism quote, which is, "We have two ears and one mouth so that we can listen twice as much as we speak." And I think that that's so important and tied into what you just said because the ag community is so strong and it's got a great history in the United States, but trust is of utmost importance for them. So it's important to meet them there and listen to what they have to say because they know a lot better than we do oftentimes.
That's right. Couldn't have said it better.
Great. Well, Maggie, thank you so much for joining me on Untangling Climate Finance. I appreciate it. You're going to be our first guest of 2026, and we couldn't have started it off in a better way. So thanks for coming on.
Fantastic. Thank you for the conversation, Jay.
Likewise. Talk soon.
Bye-bye.
All right. That's a wrap on today's episode. Kudos and thanks to Maggie for joining me and for breaking down how ag finance is shifting from climate risk awareness to real-world action, and what it will take to deliver solutions that work for farmers and lenders alike. If you'd like to dig deeper, I've linked a few key resources in the show notes, including EDF's Global Survey on Climate and Sustainability in Ag Lending, their report on financing dairy climate solutions, EDF's Climate and Credit Risk Web Tool, and their broader Ag Finance Resources Hub. And if you want to connect with Maggie directly, you can email her at mmonast@edf.org or find her on LinkedIn. Both are also in the show notes. Finally, if you enjoyed this conversation, please follow, rate, and share the show. It really helps others find us. For more on climate finance, carbon markets, and impact investing, don't miss our weekly audio brief, Sliced, which is right here on this feed. Okay, thanks for listening. I'll be back next month with another episode of Untangling Climate Finance. This podcast is brought to you by Gordian Strategies.